So you're buying a new home and you're shopping for a mortgage and you start looking at the interest rates and you think, I definitely want to get the lowest rate. But before you do that, here's why the lowest rate is not always the best rate. So today we're going to look at 4 different strategies. And what I want to show you is 4 different rate options, but also 4 different options on how much money to bring to closing, and really discuss why the lowest rate is not always the best rate. Sometimes it is and sometimes it's not. So basically we have 4 strategies. We have strategy A, we've got strategy B, we've got strategy C, and strategy D. So you look at these and you look at the interest rate and you see strategy A is 4.75 on today's pricing. Oh my gosh, that's what the rate I want, compared to strategy D, which is 5.5%. 0.75% higher. It's a lot higher of a rate. So you would think instinctively, hey, I want to take the lower rate. But keep in mind, when you're going with a lower rate, it's going to be more money to closing. So yes, it's a 4.75% rate, but you're also talking about almost $119,000 in this scenario for closing, compared to strategy D, which is almost $107,000. So there's a significant difference, over $11,000 in the amount that you'd be bringing to closing. The reason for these differences in rates for the same loan is going to be based off of points. So what we're going to show you is points are going to be, sometimes you'll hear it called discount points or an origination fee, or just points. But essentially what points are is you're spending money, extra money, to buy the rate down. It's not money you're going to get back. It's a fee, but you're using that to buy the rate down. So if you see on this scenario, strategy A, actually you're paying 2% of the loan amount, which is $8,000. Compared to strategy D, instead of paying points, you're going with a higher rate and you're actually getting money back. Now here's why this makes a big difference. If you look at the blue graph, the monthly payment difference on this is going to show you kind of the short-term difference between the 4 options. Obviously, the monthly payment is going to be lowest on strategy A because it's the lowest rate. But let's look at a little bit of a longer term. Let's look at the savings over the next 5 years. So over the next 5 years now, what we're going to show you is strategy A is going to be still saving you money compared to strategy D when you take into the account of the money that you paid up front. The money that you save each month is going to be more than the money that you paid up front. So if you're planning on keeping this loan for at least 5 years, awesome. Strategy A might be the best option for you. But what if you're going to move in 3 years? So in this scenario, I changed the orange graph from 5 years to 3 years. So if you're almost 100% sure you're going to move in 3 years, it actually makes more sense to go with the higher rate. You see strategy D in this scenario, yes, the rate's higher, but the extra money that you pay each month doesn't actually equal the money that you paid in points to begin with, so you come out ahead. I know it seems weird, but you actually come out ahead in this 3-year period. The other thing to keep in mind is refinancing. You might say, hey, I'm going to keep this house for 10 or 15 years, but rates have gotten higher recently, so you might be refinancing in a year or 2. Now let's look at that scenario. So if you potentially refinance in the next 2 years, you could actually save almost $6,000 if you look at this orange graph, going with a higher rate than you would be going with the lower rate. The reason being, once again, is the money you save each month with a lower rate does not equal the money that you paid in points up front. So you come to closing with less money and you're going to come out ahead in the long run. Now, one thing to keep in mind is, you're going to be in the house forever and you don't think there's going to be a refinance opportunity, or maybe that's a little bit too risky for you. Let's look at the green graph. And this is the interest over 15 years. This is really, you really start seeing that lower rate start making a difference. So in a 15-year period, the interest is only $245,000 over on strategy A compared to almost $88,000. So that's almost a $44,000 difference between the two. So what you want to keep in mind is today's goal, as far as your payment and the money that you're bringing to closing, your short-term goal, whether it's 2 years, 3 years, 5 years, and then your long-term goal is how long do you plan on keeping the house for? So contact me. I can walk you through this whole process. We can talk about your goals and let you make an educated decision for your mortgage, and make sure you're saving as much money as you possibly can. So I hope you like this information, and please, if you do, make a comment and subscribe to my channel. Thank you.